The Union Budget is perhaps the most anticipated economic event of the year. It gives us a detailed view of the government's economic priorities and also helps us understand where the economic health of the country currently lies. While the budget was announced last week for the year 2022, there were many discussion points in the news and elsewhere which mostly focused on the government's intention. Was this a budget which solely focused on the priorities of the states going into elections? How did the government really fare on social spending and many other accounts? This is Karan Dev, and I'm delighted to be joined today by Dr. Radhika Pandey, who is a very senior economist and policy expert. Dr. Radhika is a senior fellow at the National Institute of Public Finance and Policy. Prior to this, Dr. Pandey was the lead coordinator for the Ministry of Finance, instituted task force on public debt management agency, and has led and been a part of various research teams such as the Working Group on Foreign Investment and the Financial Sector Legislative Reforms Commission. Dr. Pandey, thank you so much for taking time out to join me on Swell. There's a lot to discuss when we think about the budget and the way the economy is doing more generally. And I'm really looking forward to hearing your thoughts on the questions which follow. Dr. Radhika, I think the emphasis of this budget, as most analysts have said, is on the supply side. Now, given the paucity in private investment in the last few quarters, how do you view the increase in capex? It's gone up to 7.5 lakh crores, and a lot of people believe that this is going to make investors more bullish on the India story. So how would you read this increase, and what are the sectors which you think will stand to benefit from this announcement?
So I think, as you rightly pointed out, the budget's focus has been on enhancing capital expenditure, because at a time when private sector has been anemic, even before the pandemic struck us, the private sector investment has been weak in India. And it further suffered a jolt due to decline in consumer demand and a decline in capacity utilization. So to pump prime the economy, the budget's focus has been on enhancing capital spending. And one major plank towards this is also giving assistance to states so that they can pump prime their capital spending. So the central government has given 1 lakh crore loan to state governments to enhance their capital spending. So towards this, it's a positive move, and looking at the sectors which will benefit primarily, if we look at the sectoral allocation, we see that NHAI has got the maximum enhancement in budget allocation. So there has been a 133% increase in budget allocation to the National Highways Authority of India. So the emphasis rightly has been on building construction-oriented projects like roads, highways, not only urban roads but also rural roads. So if we look at the projects that have got a major boost in budget allocation, it's primarily construction-oriented projects. So on the one side, the capex has been enhanced, and on the other side, the emphasis has been on employment generation by giving emphasis on construction-oriented sectors.
Thank you for that outline, Dr. Radhika. And when you think of employment and you think of just the unemployment levels in India and how to really target it, the bedrock, if you will, of the Indian economy is perhaps the small and medium enterprises. So seeing as how they form a huge part of the economy, do you believe that the budget does justice, especially given the extension in the emergency credit line guarantee scheme to them?
Yes, I think the budget does an extension of what they have been doing over the last 2 years, because as we have seen, due to the pandemic, the MSME sector has been one of the worst hit, and even outside of the budget, the government has introduced a number of policy measures to help mitigate some of the economic distress caused due to the MSMEs. One of the major policy instrument was the Emergency Credit Line Guarantee Scheme, which was to provide credit to MSMEs, guaranteed credit to MSMEs up to 3 lakh crore. And the official data does suggest that a number of MSMEs did take advantage of the scheme. There has been a study by the SBI research team, the EcoRap, that also points out that the ECLGS scheme did help in tiding over the crisis and did help prevent some of the MSMEs turn into non-performing assets, because they got loans, so they were able to sustain their businesses. They did not turn into bad loans. They did not turn into non-performing assets, and at the same time they were able to provide employment to a large section of the population. So there are various ways of providing support and to MSMEs, but the government's focus has been supply side oriented. That is not to just give them direct cash in the hands of people, but to provide them credit so that they are able to sustain their business, and to provide them credit at guaranteed credit at low rates of interest so that they are able to carry on with their business. So that is one of the instruments through which the government has aimed to help MSMEs. The other way is a revamp of the credit guarantee institution, which will also help in further enhancing infusion of credit to MSMEs. But outside of the budget also, they have been taking a number of measures to improve the business prospects of MSMEs. They have refined the definition of micro and small medium enterprises. They have also made efforts to see that MSMEs get their payments on time, because they are sellers to a large number of buyers, including government is one of the prominent buyers of MSMEs, and one of the problem that MSMEs face is that of delayed payments. So towards that, a number of mechanisms have been initiated to address these measures. So if we look at budget overall, the two highlights of the budget has been, one is to enhance the capital spending, which was also one of the focus in last year's budget, but they extend that in this year's budget by a big margin. And the second highlight of the budget is to extend the relief program that they had initiated during the pandemic time through the budget also, so that still we are not out of the pandemic and still these sectors need support, MSMEs particularly in the contact intensive sectors. So that is the underlying thinking, and on that count they have tried to provide these incentives and to extend this scheme so that MSMEs can in an uninterrupted manner access credit at low rates of interest.
Now, Dr. Radhika, as you mentioned, we're coming out of the backdrop of COVID. The pandemic isn't completely past us. But when you think of how the government really reacted to it, when you compare it to other emerging markets, I suppose the main challenge would be to provide a stimulus to help the economy as well as maintain low interest rates and control inflation. So how do you see the government fare on these counts when compared to COVID management in countries across the world? Are there case studies you can point us to, and what is your reading of just the government's reaction overall to this crisis?
So if we look at some of the other countries' pandemic response, we can broadly divide the response into two kinds. One is the response by advanced economies, particularly the US, UK, EU. So these countries did not have a fiscal constraint before the pandemic, whereas India also had a problem, did have a problem with fiscal management even before the pandemic. So if you would recall, even before the pandemic, we had to deviate from our fiscal commitments by a huge margin. Our fiscal deficit, which is a metric of, which is the difference between expenditure and revenue, it was 4.2% of GDP in 2019-20. So it's important to consider the backdrop within which COVID struck and what were the COVID management policies that India adopted vis-a-vis the other advanced economies and the other emerging economies. So advanced economies before the pandemic, their fiscal situation was sound comparatively as compared to India. So they were able to pump up their expenditure. They were able to provide huge stimulus packages, and they were also able to provide cash in the hands of people. So their assistance was mainly in the form of providing direct cash transfers to people who were affected by the pandemic, by providing them either cash transfers or providing them employment benefits and so on. That was the strategy adopted by advanced economies. Whereas in India, because we were already fiscally constrained, so the challenge was not to deviate too much from our constrained fiscal resources and to spend judiciously. So towards that, the strategy adopted was to identify vulnerable sectors, those sectors that were hard hit by the pandemic, and to provide them targeted relief. So while advanced economies strategy was to provide lump sum cash transfers, in India it was more in the form of targeted relief to sectors that were adversely impacted. For instance, MSMEs, for instance, the migrant workers or the small vendors in the urban regions and so on. So in India, the strategy was to provide targeted relief to some sections rather than going on with a big fiscal stimulus package. So that is the difference, and what it did was, if we now compare India with some of the other countries, if we look at the US and other countries, what we are now seeing is that they are facing the implications of the big stimulus packages that they introduced during the pandemic. There are two challenges that now they are facing. One is that their debt to GDP ratios have exploded by a huge margin, and particularly not only their debt to GDP ratio, but primarily their short-term debt, because they had to borrow short-term to tide over to increase their expenditure. So their short-term borrowings of the governments in advanced economies has increased tremendously during the last 2 years of the pandemic. Whereas if we look at India and other emerging economies, our response was relatively light on fiscal term because we did not have that much of capacity to spend, and therefore it was more of a targeted relief. And on the other side, we used this time to introduce reforms and to introduce supply side measures, which during that time many people criticized that this is not the time to introduce just long standing fundamental reform, but the government of India chose to use this time to introduce long standing fundamental reforms rather than going in for huge cash transfers. So now what we are seeing in the other country, one implication, as I pointed out, is the increase in debt burdens. On the other side, we are seeing an increase in inflation, because now as the COVID is receding, the purchasing power of people have gone up, so the demand has increased by huge measure as compared to supply. So demand side inflation is pushing up inflation and debt levels, whereas in India we are seeing the headwinds of that. Inflation is not primarily domestically driven, but primarily due to global headwinds.
Thank you for giving us that outline, Dr. Radhika. And, at the moment, one of the biggest talking points is cryptocurrencies, and a lot of the youth are really looking towards cryptocurrencies as a new way to really exchange transactions and perhaps as a saving tool as well. So while the RBI has been firmly against its use, the Reserve Bank is planning on launching its own version, which is called the Digital Currency Central, which is supposed to be a substitute for cryptocurrencies. And it was included in the Finance Bill of 2022. So how do you view cryptocurrencies as a medium of exchange and the RBI's digital currency plan?
So the Reserve Bank of India has been vehemently opposed to the launch of cryptocurrencies because they think that cryptocurrency pose a risk to financial stability. And there was this debate on whether the central government is going to ban cryptocurrency or is going to tax tax transactions in cryptocurrencies, because as if we look at cross-country experience, only a very handful of countries have actually gone ahead and banned cryptocurrencies. They have tried to regulate cryptocurrencies in various forms. So one way is to allow cryptocurrencies use as an asset, but not as a currency, not as a medium of exchange, but to allow its use as an asset. And many of the other countries have allowed cryptocurrencies use as an asset, and but they have put in place some regulatory frameworks towards this. Crypto exchanges have been set up. They are supposed to do due diligence. There are regulatory requirements, and so on. In India, the Reserve Bank of India is opposed to it, and it's launching its own digital version of the currency. Now, there are various ways of comparing cryptocurrencies with CBDCs on various metrics. So if we compare cryptocurrencies with the CBDC, which is the central bank digital currency, CBDC is going to be legal tender because it will be guaranteed. It is issued by the central bank, and the finance bill has already proposed amendments to the Reserve Bank of India Act to allow banknotes to be issued in digital form. So all sorts of changes to the legislative framework are being made to facilitate the issuance of central bank digital currency, which will be similar to cash, physical cash, but its form will be different. It's not printed on paper or polymer. It will be in digital form. Now there are various design features, and we can talk about those design features in detail, but in the interest of time, there are two ways. One is the account based and token based CBDCs, but that is on the design features. If we compare on medium of exchange, I think CBDC fares better because it is a legal tender. But if we compare CBDC with private cryptocurrencies as an asset, then CBDCs won't be attractive because it is most certainly going to be a non-interest bearing currency, because it will be akin to cash in digital form. So it will be a liquid digital form of legal tender money rather than as an asset. So those entities or those people who are holding cryptocurrencies to diversify their portfolio or in the hope of increasing their returns, those people will not find CBDCs as an attractive instrument, and on that measure, CBDCs and private cryptocurrencies are not substitutable. CBDC is separate. It's more in the nature of medium of exchange. It won't be an asset. Most certainly, there are models where CBDCs can also offer interest rate. But then again, we have to compare whether the returns on CBDC will match the returns on cryptocurrencies, because returns on cryptocurrencies are much more in magnitude as compared to the returns on CBDCs. So I think on those grounds, as an asset, cryptocurrency fares better than CBDC, but as a medium of exchange, the central bank digital currency will be a legal tender, it will be backed by the central bank. It is the digital legal tender currency, so it will be used as a medium of exchange by people, those who wish to move away from the physical cash and move towards digital form of payment. Though already we can argue that there are digital forms of payments like prepaid instruments like Paytm, etc. But again, CBDC is going to be legal tender, and on that metric, it will be safer and to use than the other private digital means of payments.
Dr. Radhika, before we open this up to questions, I think a conversation around the budget would be incomplete without focusing on the banking sector. So as of 2021, the non-performing assets of the banking sector have declined to about 8 lakh crore as per government estimates. And private sector banks have also posted healthy profits with a sizable reduction, a lot would say, in bad loans. So how should the government go about thinking of reform in this crucial sector, given the underperformance of public sector banks?
So banking sector reforms have to be seen in conjunction with their disinvestment policy that the finance minister had announced in the last year's budget, where they outlined a vision that the government will be in business only in strategic sectors, and that too will have a very minimal presence, and rest of the sectors will be opened up for private sector participation. Towards this, the finance minister also announced in the last year's budget that 2 banks will be opened up for privatization. Those were very important policy signals towards privatization and towards improving the efficiency of public sector banks, because time and again we have seen that a lot of taxpayer funded money has gone into towards recapitalization of public sector banks, but then also we do not see a phenomenal or even perceptible improvement in their metrics, looking at ROE, return on equity, return on assets, or even credit growth. Credit growth is also not to to the extent of private sector banks. We do not see an impressive growth in credit by public sector banks. So towards all this, gathering all this information and understanding and the trends over the last couple of years, the government finally decided to change its stance towards announcing privatization of public sector banks. And even those steps have not been, those proposals have not been actually implemented or executed, but the point that the government has at least signaled that it will be going ahead with allowing more private sector participation in the banking sector is a significant step, because it marks a reversal of the policy thinking that was prevalent till before 2021, that public sector banks play an important role and therefore they should not be privatized. So the announcement of 2021 was an important policy announcement. And we do hope that going forward steps would be taken towards actually implementing the proposal that was outlined in the 2021 budget of privatizing 2 public sector banks. So that is one reform. The other measure of reform that can be introduced in banking sector is to allow more competition in the banking sector space by allowing more licensing of banks, because if we look at the past 10 to 15 years, the licensing policy of the Reserve Bank of India has been very stringent, and not very many banks have been able to conduct their business given the licensing policy of the Reserve Bank. Only recently we have seen that the licensing policy has turned on tap, that is made more open to licensing, not only universal banks but also other kinds of banks like payment banks, small finance banks. So now there is a niche, there is an area of differentiated banks space prevalent in India because of allowing entry of more private sector banks. So one instrument of reform is by having a greater impetus towards privatization, disinvestment in the banking space. The other is by allowing new banks to enter into the banking space, that is by licensing policy, by making the licensing policy more efficient and more swift, more amenable, so that more banks can conduct business. And the third instrument of banking sector reform, which is pending, is the Financial Resolution and Deposit Insurance Bill, which should allow for exit of troubled banks. So any business will flourish if there is eased entry restrictions as well as eased restrictions on exit. So that is very important. So on the one side, there should be greater entry of private sector banks, and on the other side, the framework should be developed so that the troubled banks, the banks that face problem, they should be allowed to be resolved through market-based measures rather than through recapitalization or through force.
Dr. Radhika, it's been such a fascinating conversation so far. I think we've covered most aspects of the union budget and the state of the Indian economy as we see it today. There are still more areas that I think we can cover, but I'd like to open this up, as I mentioned in my previous post. So this conversation is now open for questions, and I will post a summary at the end of those questions, Dr. Radhika. Up until then, I just want to thank you again for taking time out to speak with me on Swell, and we're looking forward to having some questions on here.
Good evening, Dr. Radhika. I have a question regarding the financial crisis that happened in 2008. Central banks have utilized a lot of measures to enhance liquidity, but what else have the central banks done to prevent further shocks from occurring?
Good evening. So, see, from the point of view of central banks, their main mandate is monetary policy, and they have very limited tools in their arsenal to address the crisis. So on their side, what they can do is to infuse more liquidity and to ensure that credit is available more easily and at more eased rates of interest to those who want it. So businesses, borrowers, those who need credit, they should be able to avail of the liquidity at cheaper rates of interest. That is what the central bank on its side can do, because the main policy instrument that central banks have in their control is the policy interest rate. So that is what they have been doing since the global financial crisis, and even during the COVID times, that they extended their unconventional monetary policy toolkit to infuse more liquidity through various measures. But the end result is to ensure that the interest rate in the economy is low, so that businesses and borrowers are able to borrow at low rates of interest. So to infuse liquidity, there are a number of measures that they have used.
Hi Radhika, I have a question for you. The renewable energy sector is set to grow at an estimated 5 to 6% if the reports are right. So do you view this consolidation of industrial behemoths as a boon to this sector? I would really love to know your thoughts on this.
Hello, good evening. Thank you for this insightful conversation. So the question that I want to ask is that as a student of economics, who are some of the thinkers who still influence you to this day from when you first started studying the subject?
Hi Nimisha. When I started studying economics, I used to be influenced by classical economists as well as Keynesian economists, J.M. Keynes. But later on, as we now know that the situation, the economic landscape has changed a lot. So there are various central bankers that now are, we should be studying more of their works in the modern times. Basically, I would recommend Joseph Stiglitz, who is a Nobel Prize winner, and he even currently writes on contemporary issues on central banking. This entire debate on whether interest rates should be raised now in the US given the red hot inflation is something that he's been talking about, and he's giving an alternative perspective to this. So I think we should look at the modern economists now who are giving their views and thoughts and perspectives around what's happening in and around the world. So yes, Joseph Stiglitz, J.M. Keynes, even the IMF economists like the current the Vice President of IMF, World Bank. Those are some of the people that now we should be following and trying to see their policy direction.
Good evening, Dr. Radhika. My question to you would be, has the union government in its latest budget done enough to promote the manufacturing sector of the country? Because again, manufacturing is a very important sector of a country like India, where there is so much unemployment. It's a sector which can absorb a large number of jobs and transform our agrarian economy. So, do you think the government has taken enough measures to sort of promote the growth of manufacturing in the country? Or if not, what are some of the measures which can be taken to increase the share of manufacturing in our GDP?
Dr. Radhika, this was a brilliant AMA. Thank you so much. And I also had a question very similar to what Bhumik has asked about manufacturing. The problem manufacturers in India have, one of the biggest problems they have is the way debt restructuring works. So with recent changes in policies that have been enacted over the last few years, manufacturers have to declare themselves NPA if they default on payments, I believe for 90 days or something like that, and banks are not given the option of quickly helping them restructure. Instead, they have to declare NPA and go through a legal process, which pretty much ends up killing manufacturing, because there are many reasons where very good, honest businessmen are unable to pay back, short-term loans or long-term loans for a 90-day period. There could be changes in, the pandemic hit that caused a lot of change in supply and demand, or it could be just changes in that particular industry. There are global changes. There are other things, there's a ship that gets stuck in Suez Canal and causes supply chain shocks. So there are many reasons why, honest manufacturers are unable to meet a 90-day payback and to be punished with, significant legal action, rather than allowing banks who lent them the money in the first place to work with them to come up with a way to pay it back. It seems like we're trying to kill the whole sector with that, because nobody wants to enter and then have to give personal guarantees because they honestly had an industry level shock or whatever it may be, right? And now they're left with having to give up personal wealth to pay back those loans. I think without a mechanism in place for easier debt repayment, I do remember that there used to be policies in place in the past which are no longer there, which would allow for, I believe, a short period of time, like a couple of years, for debt principal repayment to come from pre-tax funds for capex assets. If a loan was taken against capex, then for a couple of years, a percentage of that could be repaid, principal could be repaid pre-tax, and so on. The backbone of the American economy has always been small business, and the funds available, the credit line available for small businesses, and the bankruptcy laws in place that protect, entrepreneurs significantly and help them become entrepreneurs in the first place. So I do believe that in order to actually help India's economy, it is just not enough to have government spending. There has to be a way to encourage small businesses and small manufacturers, and the current policies that are in place actually only scare them away. Any thoughts on this, please?
Good evening. So yes, manufacturing is an important segment of the economy, and as you rightly pointed out, the share of manufacturing sector in India's GDP has remained more or less static. So policy measures are required to enhance the efficiency and productivity in the manufacturing sector. So towards this, one of the major schemes that the government has announced is the PLI scheme, that is the production linked incentive schemes. And for a number of sectors within the manufacturing sector, the scheme has been announced. They started with the textile sector, and now it has been extended to a number of other segments of manufacturing like solar power and so on. And in this year's budget also, the PLI scheme has been extended, and the proposal is to use PLI scheme to enhance jobs and boost productivity in the manufacturing sector. So some kind of incentives are given so that manufacturers are able to set up their entities, and some kind of incentives are given. So that is one part of the story. The other important element of the policy that is needed to enhance the efficiency of manufacturing sector is to promote competitiveness. So in that respect, we see that on the one side, in some sectors, the taxes and the custom duties are being raised. So to some extent, that is fine, because we know that we've studied in economics this concept of infant industry argument, that for some time you do require to give protection to domestic industries, but that should not become a permanent feature of the policy. So protectionism needs to be guarded against, and competitive efficiency needs to be promoted. So along with PLI, what is needed is measures to give the signal that manufacturing sector needs to become competitive. Another element that needs to be promoted, and the government is doing on that respect also, is to see that the ease of doing business is further enhanced. The various kind of compliances, the various kinds of forms that need to be filled, the various registrations, licensing requirements, all those compliance burden needs to be streamlined. Some steps have been taken, but there is an immense scope for further rationalizing the compliance burden on the manufacturers and small scale industries. So that is something that needs to be looked into. Steps are being taken, but yes, there is scope for further steps to increase the productivity of manufacturing sector, such that it is able to contribute more to the country's GDP. Hello, good evening. Thank you for the insightful question on debt restructuring. I fully agree that the debt restructuring process needs to become more flexible. But if we just step back and see the policy history, the evolution of the recent policy measures that have been enacted over the last few years, what was the need to enact such kind of policies, was the fact that banks were engaging in what is called as extend and pretend. So that was the reason that a lot of evergreening was happening by banks, particularly post the global financial crisis. A lot of loans were not recognized on the bank's balance sheets, and that resulted in a pile-up of NPAs by banks, and suddenly the balance sheets of banks were distorted, and then policy measures had to be taken to recapitalize banks. So this entire thing that happened from the period of from the end of global financial crisis, that is from 2008-9 till about 2013-14. What happened was that there was a lot of pile-up of non-performing assets, because banks were not identifying and recognizing the non-performing assets, and they were restructuring, and the immense restructuring resulted in pile-up of non-performing assets which were not even recognized on the balance sheets of banks, because at that time the norms for identification and recognition of bad loans were quite lax. So that resulted in this kind of a policy response, particularly post the AQR, asset quality review, that was undertaken when Dr. Raghuram Rajan was the Reserve Bank of India governor. So they realized that banks are not recognizing and identifying the bad loans on their balance sheet. They are hiding the true extent of bad loans, and that is giving rise to, mostly it is giving rise to zombie firms, which were just taking loans, and they did not have a efficient credit culture of returning loans on time. So that resulted in setting up of the insolvency and bankruptcy code and identification of strict measures that after 90 days the loans have to be recognized. So that is the reason, because we saw that there was a lot of evergreening by banks. In fact, we have done a study on the true extent of evergreening by banks. It was quite a lot. So it was not just the due to some honest manufacturers, but also banks were hands in glove with a large number of businesses, and that resulted in a pile-up of loans because of evergreening by banks. So that resulted in this kind of a policy response where banks have to now declare NPAs strictly. So even now, even after putting in place such strict policy measures, we do see so many kinds of banking crises happening, mainly because banks are not following the due diligence norms. So we are not able to compare ourselves with the US, where there are more flexible debt restructuring schemes. Here the culture is a bit different, and therefore such kind of policy responses had to be put in place because there was a lot of evergreening going on from the period of 2008-9 to 2014-15, and that resulted, if you see the NPAs also, that was quite large during that period, and only after that we see that NPA pile-up has now gone down. And even during the pandemic, when banks were advancing loans, even then also the NPAs, the bad loans of banking sector, did not rise to that extent. So I think those kind of policy measures needed to be put in place. But yes, you are right, that also results in a lot of honest manufacturers suffering, because maybe business cycle conditions, maybe demand compression, and that results in honest entities not able to pay back. And for those, to some extent, the government has introduced for MSMEs, that is the small businesses, they have introduced more enhanced and easy bank lending facilities, but for others they have made it strict. So I think in India that was the need of the. Hello, good evening, Ramya. Yes, I do think that the kind of policy impetus that is being given to renewable energy, that is needed, particularly due to the ambitious COP26 commitments that the government of India has made to reduce our greenhouse gas emissions and to reduce our carbon footprint. The share of renewable energy has to increase in our total energy requirements, and we are taking steady strides towards that. So I think that's a good measure. In fact, more steps need to be taken on the policy side to incentivize production, manufacturing in this area, and also to incentivize people, households, to shift towards more renewable sector. There will be, of course, some cost of transition, that is movement from other sectors to renewable energy. There will be some displacement of employment. There will be some displacement and transition related costs, and the government needs to look into other countries' examples to see that how the costs of transition could be minimized.